If trading success were a simple matter of discipline, soldiers would dominate Wall Street. If it were purely about psychological stillness, the world's greatest investors would be monks. To find the real cause of failure, we have to look at the market's own baseline. Over the last 5 years, the S&P 500 returned 90%. Any trader who failed to match that return over the same period has, by definition, failed to outperform a basic index fund. 95% of retail traders never cross that threshold. Most slowly drain their accounts over time, despite their drive, intelligence, or level of motivation. When smart, dedicated people repeatedly fail to achieve a specific result, it usually means they are solving for the wrong problem. This confusion often leads to strategy hopping. A trader starts with Bollinger Bands, takes a few losses, then abandons them for RSI, MACD, or complex chart patterns. They spend years searching for a holy grail indicator that simply does not exist. Without a fixed plan, emotions take over. Greed makes you hold a winning trade until it reverses back to your entry point, and fear forces you to sell the moment a position turns red. Most people walk away from these experiences convinced they have a discipline problem. They assume their own personality is the obstacle. But consider a coin that pays out $2 for every head and loses $1 for every tail. You wouldn't need willpower to keep flipping it. Even after 5 losses in a row, you'd flip that coin as fast as possible because you know the math is working in your favor. The anxiety, the overtrading, and the panic are natural reactions to the uncertainty of risking capital without a verified edge. Building a sustainable career starts with defining a quantifiable edge. An edge isn't a prediction. It is a calculation of positive expectancy over hundreds of trades. This formula determines the viability of any strategy. By multiplying your win rate by your average gain and subtracting your loss rate times your average loss, you find the expected value of every trade. If a system wins 70% of the time with an average gain of $80, but loses 30% of the time with an average loss of $100, you are left with a positive expectancy of $26. Every trade taken without a positive number at the end of this equation leads to death by 1,000 cuts, the slow but mathematically certain erosion of your capital. Even a winning edge can fail if it isn't paired with strict risk management. Probability only works in your favor if you survive long enough for the law of large numbers to take effect. Consider 2 traders, John and Sally. Both start with $10,000, and both use that same 70% win rate system. John risks 50% of his account on every trade. Despite his winning system, a standard sequence of 3 consecutive losses clears his balance. Sally risks only 1% per trade. Those same 3 losses barely affect her capital, allowing her to stay in the game and capture the next 7 wins that push her account into a net profit. Risk management acts as a structural safeguard, ensuring that the inherent randomness of the market doesn't interfere with your long-term statistical advantage. Success finally requires the mechanical execution of the system. If you suffer 3 losses and get scared, you might skip the 4th signal. But if that 4th signal is the one that delivers the system's largest payout, your inconsistency has just turned a winning strategy into a losing one. The math of the market only rewards those who have the discipline to take every valid signal the system provides, regardless of how they feel in the moment. Even with a proven edge, a trader remains vulnerable to changing market conditions. A strategy designed for a bull market will often lose money when the market turns choppy or moves sideways. Professional traders mitigate this risk through diversification, not just of stocks, but of systems. Running multiple uncorrelated strategies allows the profits of one system to offset the drawdowns of another. This approach smooths the equity curve during periods of extreme volatility. When a major financial shock hits, having overlapping systems increases the probability of remaining profitable throughout the year. This structural resilience allows a portfolio to withstand geopolitical chaos and sudden shifts in the global economy without requiring the trader to correctly guess what happens next. To find consistency, stop viewing trading as a battle of will against your own emotions. Profitability is the result of viewing failure as a technical defect, confirming your mathematical edge, and allowing probability to do the heavy lifting.